Okay, guys, welcome to tonight's session. So we're covering FAC4861, FAC4863. In tonight, we'll be, so this week's lesson is about PPE, intangible assets, and impairment. The main focus will be around impairment, but in order to do impairment, you need to know PPE, you need to know intangible assets. We're going to have to make partly a makeup again for this lesson. We're going to end up about in an hour and a half, around 7:30, 7:45, because yeah, I'll be having load shedding over here, so I need time to have the recording to actually record. Just now we run into problems that I lose the recording. Okay, so we'll do part of the question. We'll follow the same approach as yesterday, where I'll be reading the scenario. As we read the scenario, I'll bring to your attention the critical aspects of the topic and so forth. So just as a side, what I've also done, I've created, I'll add you guys to it by tomorrow. I've created Google folders. So I'm going to be doing the workings no longer in Excel, but I will be doing it in Google Sheets, basically Google's Excel. So then as I do it, it's going to be saved automatically. So then you will have access to it immediately once I add you guys to the group. So it saves me from resending and all of those type of stuff. So you one time have access it from the beginning. Okay. So just note, you will get an email, most likely a notification email to say that you added to a Google, a Google Drive. Okay. So once you get that email, you might just check that you can access it. I'm not going to give you permission to be able to edit it, but I will give you the permission in order to download it. Okay, you can view it, you can comment, and you can download it, but you will not be able to edit the workbook in the Google Drive. So I don't want too many people to work on it just in case we lose some of just in case some stuff change. Okay, so just some admin out of the way. We're just going to make our life a lot easier that way. Okay. So I'm now going to switch over into into the test 3, so it's FAC4861, test 3, 2019. Just so you know that for those that is doing CTA level 1, you only cover 3 topics. You only cover PPE, intangible assets, and impairment. Okay. Then for CTA level 2, you cover those 3 topics, but in addition to that, you will cover investment property. You will be covering non-current assets held for sale, as well as borrowing costs. So this week will be the only week for CTA level 1. If you want to join next week, you can, but we're still going to be covering impairment and PPE, but I'm going to be choosing questions that is on a CTA 2 level. So it may include investment property, it may include borrowing costs. So you must feel whether you're comfortable with that. But ultimately, there's no need for you to join next week and so forth, but you will have activities that you need to do and submit to me. Okay, so you'll submit on the platform, activities that you need to complete. So just be aware of that. Take note, impairment is a very big topic. Okay, so it's a huge topic within the accounting standards. It's also a huge topic just in general in the real world and all of those type of things. Okay, so impairment gets tested. If you're a financial accountant, you're going to make use of impairment. If you are an auditor, you're definitely going to be testing for impairment. So all of those type of things. So just be aware that it is a big topic and they do test it extensively. So I'll just switch over now. So if you can also open up, you should have received an email on Sunday, I think, whenever it was. Yeah, on Sunday. And I've provided you with a TAT letter. So it is FAC4861, TAT letter 104 of 2020. This question 1 is test 3, 2019. Okay, so I'm going to start reading, and then we will, as we read, we will explain high level the topic as a whole. Just one thing, there's something wrong with the platform. So just, I don't know if you guys also having it, but the undergrads is they can't access the platform, so it's being sorted out. It should be resolved by tomorrow or Thursday. What's tomorrow? Yeah, tomorrow or Thursday. So just let me know if it's also with you guys as well. But I know the the undergrads, MAC 3701, MAC 3702 is having access problems. So it's being resolved and then it should be sorted by tomorrow or Thursday. So we say African Global is a manufacturing company that specializes in the development and manufacture of technologically advanced security systems. The company has a 28 February financial year end and is listed on the Johannesburg Stock Exchange. Okay, so they're giving some background. There's 3 important things over there. Number 1, they're telling you what type of company, or what, they're telling you the company is a manufacturing company, and they're telling you what they specialize in. Okay, number 2, they're giving you the financial year end, very important for accounting purposes. And then number 3, they're telling you that it is a listed company. For accounting purposes, at least for us, it is not a significant issue. But before, when you were a listed company, there's 2 accounting standards that is specifically only applicable to listed companies, and that is segmented reports and earnings per share. Now, both of those were examinable. Earnings per share was quite a big topic in our syllabus, but I think like 2 or 3 years ago, SAICA removed earnings per share from the syllabus. And then segmented reporting, it's kind of there, but it's not really there. So they also don't really test that. So when you saw you were a listed company, then from an accounting perspective, what you needed to know was be aware that the accounting standards specifically applicable to a listed company, earnings per share, and segmented reporting, operating segment, something like that is a standard called. But for our purposes now, not anymore really relevant. So here they have a security camera plant. So on 1 March 2015, so that is the beginning of a financial year. We don't know which financial year, but you know, because a financial year is 28 February, the beginning of a financial year has to be 1 March. So 1 March 2015, African acquired the security camera manufacturing business from Busasu, an independent third party, and recognized the acquisition thereof by processing the following journal entries on the same day. Okay, so they bought a business, the camera manufacturing business. So on 1 March, they said debit manufacturing building, SFP, debit equipment, SFP, debit security camera patent, 2 million, debit inventory, credit provision to dismantle the manufacturing building, debit goodwill, credit bank. Okay, so they paid 27.25 million for a group of assets, as well as a liability associated with that business. What's important, remember, we're dealing with the topics of PPE, intangible assets, and impairment. When it comes to impairment, IAS 36, impairment of assets. So that standard deals with impairing the impairment of assets, as the name says. However, what you should know that IAS 36 only applies to certain assets. So IAS 36 only applies to certain assets, not all assets. Remember, all the assets that we cover is inventory, is PPE, intangible assets, financial assets. We will be covering leased assets, and what did I miss? Investment property. Okay, so those are the 6: inventory, PPE, intangible, investment property, financial assets, and then leased assets. I don't know if I missed something, but anyway, those are the assets that we cover. Now you need to know which of those assets fall within the scope of IAS 36. So what you should know, that PPE and intangible assets fall within the scope of IAS 36. So when you have a PPE asset and when you have an intangible asset, then you know IAS 36 impairments apply to that. Financial assets, IAS 36 does not apply to financial assets. Why not? Remember, IAS 36 deals with impairment. What do you know? That IFRS 9 has its own impairment criteria. Okay, so therefore, financial assets does not apply to IAS 36 does not apply to financial assets. So if you get a group of assets and you see financial assets, you must know IAS 36 is not applicable to that asset. The second asset that is not applicable to is inventory. Because if you read IAS 2, IAS 2 has its own impairment criteria. If you remember, inventory is recognized at the lower of cost and net realizable value. Net realizable value is in effect inventory's impairment criteria. Okay, so therefore, financial assets and inventory is not in the scope of IAS 36 because those standards have their own impairment criteria. So we left with PPE. We said PPE is fully in the scope of IAS 36. Intangible asset is fully within the scope of IAS 36. Then we have investment property. Investment property, and this is for CTA level 2 students, investment property, it depends. If the company uses the cost model, then it will fall within IAS 36. But if the company uses the fair value model, then it does not fall within the scope of IAS 36. Very important. Then we look for the leased assets. If remember, a leased asset is classified somehow. So if the leased asset is classified as intangible, or if the leased asset is classified as PPE, then it will in the scope of IAS 36. So just take note of that. Okay, so take note. So here you can see manufacturing building, it is PPE. So if we have any impairment related stuff, it will apply to the manufacturing building. Equipment is PPE. So if there is any impairment implications, it will be applicable to the equipment. Security camera patent. A patent is an intangible asset. Intangible assets is in the scope of IAS 36. So if there is any impairment implications, that will be subject to the impairment. Inventory, it's inventory, so it does not fall within the scope of IAS 36. So if there is any impairment implications, we have to ignore inventory. Now remember, you must tell them in the exam why you're leaving inventory out. You will just tell them that inventory is not within the scope of IAS 36. Then we have provision to dismantle the manufacturing building. That is a liability. IAS 36 relates to impairment of assets. You only impair assets, you don't impair liability. So therefore, it will not form part of any impairment implication. Then we have goodwill. Goodwill falls within IAS 38, intangible assets, and as a result, it is subject to impairment. If you read IAS 36, there's specific details relating to how to impair goodwill. Okay, so just take note of that. Very important. They're always going to test that. They're going to include certain assets, and they will also throw in liabilities. And you must know that liabilities is not an asset, so it is not subject to impairment. And then whatever assets they are, you must identify which of those assets fall within the scope of IAS 36, and as a result is subject to the impairment implications. Okay, so just take note of that. So you may assume that this journal entry is correct and that the underlying assets and liabilities of the security manufacturing business cannot generate cash flows independent from each other. You must look out for this. Generating cash flows independently. Can it? Yes or no? They said it cannot generate cash flows independently. This has a significant implication. This has a significant implication when it comes to to impairment. From the beginning of time, or not from the beginning of time, but basically from the time we did accounting and did impairment. I don't think in grade 12, for those of you who did accounting in high school, I don't think grade 12 covers impairment, but definitely in first year, second year, and third year, they deal with impairment. Now, the way they dealt with impairment was not to the full, the way we dealt with impairment in first, second, and third year was not applying I-36 in its fullest, whatever you want to call it. Okay. What we did was we assumed we always impaired an individual asset. We always impaired an individual asset. Now, I-36 says you should impair the smallest group of assets. Okay, so basically, you need to impair. You must first look whether you can impair an individual asset. If you can't impair an individual asset, then you must look to the smallest group of assets that you can impair. So how do you do this? The question you need to ask yourself is, can the individual asset generate cash flows independently? If it can, you impair that asset individually. If it can't, you need to find the next smallest group of assets that can generate cash flows independently. That is known as a cash generating unit. So you either impair an individual asset or you impair a cash generating unit. You first try to impair an individual asset. But when can you? Only if the individual asset can generate cash flows independently. If the asset cannot generate cash flows independently, you need to impair it as part of a cash generating unit. Now, the definition of a cash generating unit is the smallest group of assets that can generate cash flows independently. Now, an example of an asset that can generate cash flows independently is a building that is leased out. So the building is generating rental income. That is a cash flow. So the building can generate cash flows independently. In that case, you can impair the asset individually. However, if you think about Coca-Cola, for example, if you think about Coca-Cola, they have machinery and so forth. The machinery on its own cannot generate cash flows independently. The machines don't give you cash. The machines give you Coke, and it's the Coke that generate cash flows. So it's together with other stuff that they need to put into place. They need the patent of the Coke. They need bottling. They need this. They need that. So the machine on its own cannot bring in cash flows. It can only bring in cash flows in combination with other assets. So just take note of that. Okay, so it's very, very important. In most cases, they will tell you that whether the asset can generate cash flows independently or not. So in this case, they're telling you each individual asset cannot generate cash flows independently. Therefore, we cannot impair the asset on its own. We're going to have to impair the asset as part of a cash generating unit. Or to be more accurate, the impairment test cannot be done on an individual asset. The impairment test must be done in terms of a cash generating unit. So just take note of that, okay? So they say on 1 March 2015, the following was estimated. Manufacturing building, the useful life 20 years, equipment 20 years, and security patent indefinite. So what you should know, that impairment, you only perform an impairment test if there is an indication of impairment. So you only perform an impairment test if there is an indication of impairment. If there's no indication of impairment, then you don't do an impairment test. But there are 2 exceptions, okay? Exception number one is if you have an intangible asset and the intangible asset has an indefinite useful life, then you are required to test for impairment annually. And or if you have goodwill, then you are required to test for impairment annually. As you can see over here, there's the security camera is an indefinite useful life, and we have goodwill. So therefore, for those two assets, if they could generate cash flows independently, we will have to test for impairment for those two. But remember, none of these assets can generate cash flows independently. It can only be they can only generate cash flows as a unit together. As a result, because that cash generating unit includes goodwill and it includes an indefinite useful life intangible asset, we have to test for impairment irrespective whether there is an indication of impairment. In the real world, the auditors is going to ask management, show me your assessment of having a look, assessing the indicators of impairment. So every year, a management needs to assess whether there are any indication of impairments. If there is, they do an impairment test. If there's no indication, they don't do an impairment test. But they need to show some form of evidence that they have considered whether there are any indications of impairment or not. In many cases, that doesn't get done. So they just do it when the audit guy comes and they ask for the information. Like, oh yeah, they'll just quickly type out something. Okay, so so in the real world, you have to still consider indicators. Now, when you read the standard, they will tell you there are two types of indicators. You have internal indicators and you have external indicators. External is basically the industry and the environment in which you operate. So, for example, and it impacts everyone in that industry, it impacts everyone in that environment. Okay, so for example, if a competitor comes in, that's an external factor. So if a competitor comes in, a competitor coming in, that in itself is not enough. If a competitor comes in and it affects your sales, for example, then it is an impact. Okay, but a real world example, the pandemic. As you could understand, when we had the pandemic, what happened? There was a lockdown, right? And that reduced sales and so forth. Look at restaurants suffering, SAB suffering. So a lot of companies, the tobacco industry suffering. So at least during that time. So as you can see, that was an external factor of external indicator. So the auditors who are auditing them is going to obviously have to test. They're certainly going to have to test for impairment. Internal factors would be loss of market share or obsolete goods, things like that. Okay, that are internal indicators of impairment. So management have to assess for external as well as for internal. If there are any indication, they must perform an impairment test. If there's no indication, there's no need to perform an impairment test. But remember, in this case, because we have goodwill and we have an intangible asset with an indefinite useful life, you have to test for impairment. So either or. In this case, we have both, but either or, then you have to test for impairment. Just take note, goodwill can never generate cash flows independently. Just think back to FAC 2 or FAC 4 when you do groups. How do you calculate goodwill? What is goodwill? Goodwill is the excess amount that you paid, is the excess amount paid over the assets and liabilities you acquired. So goodwill is like a leftover number. There is no underlying asset. So goodwill in itself can't generate cash flows. You can't sell goodwill, and it can't generate cash flows on its own. As a result, goodwill will always have to form part of a cash generating unit. Because remember, goodwill only arises as a result of a business. So just be aware of that. Okay, so here we have that. And then there's equipment, residual value, 200,000. So remember what's the purpose of that? With residual value, when you work out depreciation, if you're using the straight line method or you're using the units production method, then you will say cost price minus residual value. That gives you a depreciable amount. Depreciable amount divided by useful life will give you your annual depreciation. So let's read further. On 28 February 2019, headline news implied Africans' involvement in fraudulent activities when an irregular government contract was granted to the company for the supply of security cameras. Due to the reputational damage that it has caused, it is expected that African security camera sales will be adversely affected. Okay, so now remember, there is an external impact over here. Okay, so that information is impacting the sales. Now remember, impacting of the sales basically reduces the value in use, reduces the selling price of the cash generating unit. So we can assume, they never said as yet, but they need to tell us, but we can assume that all of these makes up a cash generating unit. Okay, so all the assets acquired and the liabilities assumed plus the goodwill, because none of those assets can generate cash flows independently, we can assume that them together, that business as a whole, would be the smallest group of assets that can generate cash flows independently. So that is a cash generating unit. So by the fact that camera sales will reduce, the value in use of this will be impacted. So that is an indicator of impairment. But whether or not there was an indicator of impairment, we will still be required to test for impairment, because the cash generating unit includes goodwill and an indefinite useful life intangible asset. Okay, but here is a typical indicator of impairment. Okay, camera sales will be adversely affected. It must be a negative impact, okay, not a positive impact. According to African's procurement policy, all the contracts have to be authorized by the directors of the company. To date, the directors of the company have indicated that they do not intend to investigate the matter in order to identify the person responsible for obtaining the irregular contract. So, if you look at the, if you go to page 50, you will see, they'll tell you what the question is about. It is about intangible assets, PPE, impairment, and ethics. So obviously this is an ethical issue over here. And an even bigger ethical issue is that the directors is not even going to look into the matter. Okay, so that is kind of alarming, okay, and scary. On 28 February 2019, the fair value less cost of disposal of the security camera manufacturing business. So here they're giving us the fair value less cost of disposal for the cash generating unit, which constitutes the amount that an independent third party will pay to acquire all the assets and the associated liabilities of the business that the purchaser is required to take over, amounting to 21 million rand. On this date, the value in use after deducting the carrying amount of the associated liabilities was determined at 21.5 million. So let's just stop over there. When there is an indication of impairment, you have to do an impairment test. Or if you have goodwill and or an intangible asset with an indefinite useful life, you are required to do an impairment test. The impairment test is saying you must compare the carrying amount to the recoverable amount. The carrying amount of the individual asset, if the individual asset can generate cash flows independently. If not, you must compare the carrying amount and the recoverable amount of the cash generating unit. What is a cash generating unit? The smallest group of assets they can generate cash flows independently. So in this case, we won't do an impairment test on an individual asset level, because none of these assets can generate cash flows independently. So the impairment test will be performed based on a cash generating unit. So what's the impairment test? Comparing carrying amount to recoverable amount. Now remember, we must do this on 28 February 2019. They gave us information as at 1 March 2015. So we need to go from 1 March 2015 up until 28 February 2019 and get the carrying amount of the cash generating unit. The way you get the carrying amount of the cash generating unit, you must factor in all the assets and the liabilities of the cash generating unit. So you need the carrying amount of the building, of the manufacturing building at 28 February 2019. You need the carrying amount of the equipment at 28 February 2019. Same for the security, same for inventory, same for the provision, and same for goodwill. Okay, remember, even if an asset does not form part of the scope of IAS 36, when you work out the carrying amount of the cash generating unit, you must include all of those assets. Please be aware of that. Okay, so even though inventory is not within the scope of IAS 36, we still need to include it in the carrying amount of the cash generating unit. Okay. So we need to get the carrying amount at 28 February 2019. Then we must compare it to the recoverable amount at 28 February 2019. So what is the recoverable amount? The recoverable amount is the higher of. It is the higher of the fair value less cost of disposal and the value in use. So as you can see, fair value less cost of disposal, 21 million. Value in use, 21.5. Which is the higher? It is the value in use. So our recoverable amount is 21.5. Now we compare the 21.5 to the carrying amount of the cash generating unit. Okay, of the cash generating unit. If the carrying amount of the cash generating unit is less than the recoverable amount, there is no impairment, because we want carrying amount. And if carrying amount is less than recoverable amount, we're happy. But if the carrying amount exceeds the recoverable amount, if the carrying amount is more than the recoverable amount, then there will be an impairment. The basic rule or the basic principle is that an asset cannot be recognized on the statement of financial position at an amount that is more than the future economic benefits. Okay, so I'm going to say again, an asset cannot be recognized on the statement of financial position at an amount that is more than the future cannot be recognized an amount that is more than the maximum future economic benefits. So the recoverable amount is the maximum future economic benefits. The recoverable amount is the maximum future economic benefits. So if the carrying amount is less than the recoverable amount, if it is less than the maximum future economic benefits, we are happy to leave it at carrying amount, so there's no adjustment that needs to be made. But if the carrying amount is more than the recoverable amount, that means the carrying amount is more than the maximum future economic benefits. So that implies we have to reduce it so that it's not more than the maximum future economic benefits. Therefore, we will have an impairment. So just take note of that. Okay, so here they're giving us some. Some recoverable amounts. So we have on 28 February, carrying amounts on 28 February 2019. The following information is available in respect of the security camera manufacturing business. You may assume that these amounts are correct. Okay, so here we have manufacturing building. The carrying amount is unknown, meaning you have to calculate it. Equipment, unknown, you have to calculate it. Security camera, given. Inventory, given. Provision to dismantle. Okay, we're gonna have to work out what is the we're gonna have to work out how to calculate this. And then we have a deferred tax liability. So remember, we must include everything in the cash generating unit. What's important to take note, as you can see, not applicable for fair value less cost of disposal for deferred taxation, and there won't be a fair value because it's a liability. Okay, then they're giving you this relating to the other assets. We're going to use this when we do the impairment. I'm not going to discuss it now. I'll discuss it when we actually do the impairment calculation, so you can see how it fits in. It is something that you'll see when I get there. I'll explain it. So now we can deal with the notes. So let's say accounting policies. The manufacturing, building, and equipment are accounted for according to the cost model in terms of IAS 16, and they are depreciated over the respected useful lives according to the straight line method. Intangible assets with an indefinite useful life are accounted for according to the revaluation method. African test their cash generating unit annually for impairment at year end. Okay, they have to. Okay, so the test at year end. While they're telling you, but remember, when you test for impairment, you must do it annually, but it does not mean it has to be at year end. It can be, so for example, it can be close to year end. Okay, so generally, I think it will be between a 9 to 12 month period. So remember, many companies have lots of assets. If they must test every single asset at year end for impairment, I don't think they'll be done in time for to report their financial, to complete the financial statements. So what they will do it throughout the year. So there will maybe one batch of assets will be done at a certain point of the year, another batch of assets, another point of the year, and so forth. So the accounting standards allow for that it can be done throughout the year, provided it is the same assets done at the same time each year. You can't decide if vehicles is mid-year and the next year is the year end. It needs to be the same time every single year. And then for those that is done not at year end, management just need to make a quick assessment to see whether the assessment they did throughout the year is still valid at year end, but they don't need to re-perform an impairment test. This is just for practical purposes. When you go into auditing or when you become a financial accountant, you will understand why that makes sense, because it's not going to be practical for a company to do every asset at year end. Okay, so just be aware of that. So they're telling you the impairment is done at year end. Therefore, we can use carrying amounts at year end, and we can use the recoverable amounts at year end. Okay, so that's all they are telling you. Okay, they're using the revaluation model. Okay, cool. Then they're saying manufacturing, building, and equipment. What was the first one? Okay. Manufacturing, building, and equipment. On 28 February 2019, there was no indication that the manufacturing, building, and equipment individually were impaired. The residual value of the equipment did, however, change to 350 on this date. So as you can see, there's going to be an impact. Here they're bringing in change in estimates. So here they're bringing in change in estimates that you covered at the beginning of the year. So you must be able to work out the carrying amount given the change in estimate. Inventory on 28 February 2019 included in the inventory balance of 400,000 rands worth of security cameras that have outdated systems and could only be sold as spare parts at 25% below their cost price. Okay, so remember, there's a net realizable value issue, but don't get caught up now. That is a net realizable value issue. However, that you will have to deal with when you do the carrying amount. But what you should know that inventory does not fall within the scope of IAS 36. Okay, it has its own inventory standard. I mean, it has its own impairment criteria within the inventory standard. Then they say the security laser beam plant. During November 2016, management decided to acquire a machine, so beam, what is that, beam 4, to assist with the manufacturing of security laser beams. The following information relates to the machine. So here, what are they testing over here? All that they are testing over here is the following: whether you can cost PPE. Remember, when we dealt with inventory at the beginning of the year, we said the cost of inventory is all costs incurred to bring inventory to a place and condition ready to be sold. The same principle applies over here. It is all costs incurred to bring PPE to a place and condition ready to be used. Okay, so here you have the purchase price. Okay, then you have a trade discount, then you have installation costs, and you have allocated electricity costs for duration of installation. Okay, so we'll have to have a look whether what we include, what we don't include in the cost of PPE. So they said the machine had to be located in a well-ventilated area, which required 3 other machines to be relocated to a different area at a cost of 37,500 Rand on 20 December 2016. Although the installation of the machine was finalized on 1 January 2017, the machine could only operate at 60% of its full capacity. This resulted in a 90,000 Rand loss for the month of January 2017. The machine is accounted for according to the cost model. Thereafter, the machine could function at full capacity. Okay, the machine is accounted for. The machine is accounted for according to the cost model in terms of IAS 16 PPE. Depreciation is written off according to the straight line method over the remaining useful life of the machine, which totaled 10 years at initial recognition. On 1 September 2018, a significant component had to be replaced at a cost of 315. The component has a useful life of 3 years only. At initial recognition, this component was not identified as a separate component. Okay, so we will deal with that separately. This is an issue within IAS 16. When we won't deal with it in this lesson. When I cover it again, I will deal with more. I will go into more detail regarding that. Here's this thing now. Okay, you may assume. Okay, what is that? So this discount rate is for that that provision for dismantle. Just take note. You may assume that an annual after-tax discount rate. Remember, in accounting, in management accounting, in math, in MAC, we always use an after-tax discount rate. Now, this is where they're going to integrate the 2 subjects. This is one of the areas where they can integrate the 2 subjects. And in accounting, they love to test it, okay, because it fits very nicely in with the calculation of the value in use. I'm not 100% certain whether CTA 1, I cannot remember, whether CTA 1 is, you need to know the value in use calculation, but I think you do. But definitely CTA level 2, you must know a value in use calculation. Typically what they will do, they will give you a value in use calculation and you need to evaluate what is right and what is wrong. Now, typically a management is going to perform the value in use calculation similar to how they do by applying financial management principles. Okay, so they may include tax consequences. Now, from a financial management point of view, including tax consequences is correct. But from an accounting point of view, it is not allowed. The reason being is accounting records tax separately. Just think about it. You have sales, cost of sales, gross profit, other income, other expenses, profit before tax, and then you have income tax. So they don't want things to be after tax, because tax needs to be accounted for in a separate line item called income tax. Now, I'll tell you now, you need to see that integration because they do bring it across quite often. Definitely for CTA level 2. You must be able to, when they give you a value and use calculation, you must identify issues like this. They will most likely prepare the value and use calculation by using financial management principles. They're not entirely incorrect. The only incorrect aspect would be one of two things. Number one would be that they take tax into account, and as a result, they use an after-tax rate. For accounting purposes, tax must not be taken into account, and you must use a before-tax discount rate. So we need to adjust this rate. And then second, but we will come there. I have a question. I think I selected that question that has it, where when you do a value and use calculation, you must not take into account what's the terminology they use? You must not take into account future things. Okay, so for example, you must not take into account the fact that if you improve this, you'll get a better asset. You can't take it, you must take the asset as it is in its current condition. So they bring in those two aspects. But when I get that question, I saw it somewhere. When I get it out for you, I will show it. We will work through it. Then I'll show you what I mean. So remember, very important. Subtly, they're just telling an after discount rate. They want to see whether you know for accounting purposes, it needs to be before tax. What is the reason? Because tax is accounted for separately. So, okay, so just be aware of that. Okay, so that should be the entire, yeah. So I want to deal with, so you see here's part C, which is that beam 4. We're not going to deal with that. This is what I want to cover. And that is to prepare the journal entry in the accounting records of African Global Ltd. So the journal entries, okay? So we need to do the journal entry, but before we can do the journal entry is going to look very similar to this. Oh, what did I just do now? The journal entry will more or less be, obviously, the line items will differ, but it'll basically look like this. Okay, so journal entry will probably look like this, something similar. You can see not a lot of line items, but it's 18 marks. Why? Because the impairment calculation is quite extensive. So there's going to be an extensive calculation that we're going to have to do. So I'm just going to touch on it now because my light is going to go off soon. And then we're going to have a makeup session this weekend. I'll tell you which day we can arrange, which day most of us are available. And then we're going to finish this impairment question. Okay. So I'm just going to go on to Google quickly. I mean, Google Sheets. So like I said, for those that only joined just now, we're going to end a bit early today because my light is going off. So to make sure that I don't lose the recording, I need to end it slightly earlier. That's number one. Number two, to finish off the question, we will do it this weekend. I will just communicate with you a time that is suitable for most of us. And then number three, I've created, I'll add you guys to it. I won't be able to add it now tonight, but tomorrow. I already created the groups. I already created the group contacts, and I already created the group in Google Drive. So for example, let me just show you actually. You should be able to see. Okay, wait, I can't show you, it's fine. So you will get access where I'm doing this spreadsheet. So this spreadsheet is using Google Sheets. So it's as I'm going to work through it, it's automatically going to update. So once I give you access by tomorrow, then from tomorrow onwards, you'll be able to access the thing in real time. Okay, so then there's no issue of me still having to send it and save it and all of those type of stuff. It will be automatically saved and will be ready there for you to access. But like I said, I'm not going to give you edit rights. I'll give you, can't remember what's the rights, but it's basically the second level of rights where you can comment if you want to comment, but you can't edit, but you will be able to download. Okay, so when you download, you should be able to then edit, but you won't be able to edit within the folder. Okay, so remember, what do we need to do? We need to compare carrying amount to recoverable amount. So remember, for impairment, so it works as follows. Just as a rule, you don't write this in an exam, just for our purposes. An asset cannot be recognized on the statement of financial position at an amount that is more than the maximum future economic benefits. Now remember, the maximum future economic benefits is your recoverable amount. If there is an indication of impairment or you have goodwill or an intangible asset with an indefinite useful life, you are required to test for impairment. Okay, so we are required to test for impairment. So the impairment test is as follows: carrying amount versus recoverable amount. Now remember, the accounting standard says, I-36 says, you need to impair an individual asset, but you can only impair an individual asset if the individual asset can generate cash flows independently. The scenario told us that the underlying assets cannot generate cash flows independently, so therefore we can't perform the impairment test at an individual asset level. We have to perform the impairment test on a cash generating unit level. Remember, cash generating unit is the smallest group of assets that can generate cash flows independently. So in this case, the camera manufacturing business, that is the cash generating unit. That is the smallest group of assets that can generate cash flows independently. Now, what we'll have to do over here, we will have to list all the assets. Okay, so we have to list all the assets. So you must list all the assets and all the liabilities that that makes up the cash generating unit. So remember, it was machine, what was it? Machinery building. Can I remember? What was it? It was a manufacturing building. Manufacturing building. Then it was equipment. Then it was, what was the other one? Security camera patent. What was the other one? Secure inventory. Am I right? Inventory. Then it was provision for whatever it was called, provision for dismantle, and then it was deferred tax. Did I miss anything? Let me just check. If I go to the carrying amounts. So it's manufacturing, welding, equipment, security, inventory, provision, and deferred tax liability. Okay, so deferred tax liability. Okay. So this will make up our, so that will make up, okay, so that will make up our carrying amount. So our carrying amount will equal the sum. So carrying amount will equal the sum of those. Remember, an asset will be positive, a liability will be negative. As you can see, the carrying amount is including assets that does not form part, that does not fall within the scope of I-36. You must include all assets and all liabilities that form part of the cash generating unit when you work out the carrying amount of the cash generating unit. So just take note of that. Okay, then we're going to have recoverable amount. So let me just do that. Okay, so remember the recoverable amount is the higher of. Okay, so the recoverable amount is the higher of, what is it the higher of? Fair value less costs of disposal, and value in use. Okay, so it's the higher of. So the fair value less cost of disposal was given to us as 21 million. And value in use was given to us as 21.5 million. And so therefore, what is the higher? It is going to be, so what is the higher? It is going to be the 21 million, 21.5. Okay, so the higher is 21.5. Then we will compare this to the carrying amount. So remember, if the carrying amount is more than the recoverable amount, then what we're going to do, we will impair. If the carrying amount is less than the recoverable amount, then we have no impairment. Okay, so just take note of that. So here we can just do this. So I'll have impairment. Oh, we forgot something, eh? We forgot something. Don't forget to bring in Goodwill. Don't forget Goodwill. Because remember, if we have a look over here, they're only giving us the carrying amounts there, but we must go look at it on top. What was part of the business? So what happened here now? What was part of the business? It was the manufacturing building, equipment, security camera. We have those three. We have inventory. We have the provision. But they never gave us Goodwill. So don't forget, you must include Goodwill. They never said anything regarding Goodwill. There was no change. So what you can know is that the carrying amount of Goodwill, we know so far is 1350. 123. Okay, so what I want you to do, I'm going to have to stop here. There's no point going further. What I want you to do, because you're going to do accounting from high school, first year, second year, third year. All I want you to do is get me the carrying amounts of these, okay? So have it ready for our next lesson. If you don't have it ready, it's okay. I'm going to still do it, but try to do it so you can see if there's anything that you may be, so you can see if you made a mistake, where you made a mistake, you will learn better that way. So try to have your carrying amount. We already have the recoverable amount. Once you do have your carrying amount, then decide whether you have an impairment or not. Then just stop over there. Whether you do it or don't do it, it's fine. I'm still going to be doing it in our next lesson. And then we're going to continue with the impairment. So there's no point going on further because we're going to have to redo whatever we do now again. If I'm going to start something now, I'm going to have to redo it. So I'm going to stop here for tonight. Then the weekend, probably on Saturday, we're going to do just to complete the question, because I have to stop now. My light is going to go up in the next few minutes. But before we stop, is there any questions at this point in time? Ashita, do you have any questions? Bernice, Fakir, any questions? Bernice, Ashita, nothing. Fakir? Melissa?
No questions.
You have questions, Ryan? What did you say? No question.
No,
Okay.
no questions.
No questions. Melissa, Rebecca, Rodney? Okay, cool, all good. Melissa, Rebecca? Sibinzile? Okay, Melissa,
No
Rebecca,
question, thank you.
okay. So I'm going to stop here now. So if there's nothing can save, probably on Saturday, I'll tell you what time, and then we can chat in the group. We can confirm a time. We're just going to finish up this question. So this is a very nice question on impairment. So you want to do this, and then I'll tell you which question to do afterwards, which is a little bit more complicated than this one. So this one is a nice question, but not as complicated as one of the other ones I gave you to do on your own. And then I'll tell you which one to do. They're going to test quite another 2 or 3 more principles that is going to wreck your brain. And then you're going to see, you're going to feel that you have learned, you have improved, you have grown after you do these 3 impairment questions. Okay, so I'll see you guys for the fact 2, guys. We'll have tomorrow. So far, there's no load shedding, but we will see in the morning if there's again load shedding, but hopefully not, so we can finish tomorrow. Tomorrow, we're going to do changing ownerships. Okay, and then so I'll see you guys tomorrow. Okay, if there's no other questions, you guys can leave. Thanks, bye-bye.